Tesla violates the 3-day rule on the way to 1,000 a share on S&P entry. Want to thank our singers, and we'll be having a note on who they are and some more of their work. This is Greg for Teslafaninsight. Thanks once again for joining us. If this is your first time, welcome. If you're a repeat visitor, welcome back. Also wanted to thank our Patreon supporters. Your support makes a huge difference. And if you'd like some good info on a daily basis in preparation for investing/trading, I think you'll find the information helpful. If you also are interested in one-on-one coaching as you trade, invest your way through, enter the S&P, please drop us a note on either the Facebook page or if you're a Patreon supporter. At any rate, I want to thank you for joining us today. We're in a pretty interesting everyday show zone based on new developments that are happening with Tesla. On a daily basis, we kind of try to gather information from Wall Streeters as well as from folks that might be in our trading group to kind of determine what are some ideas that one might want to incorporate into what you're doing trading-wise. And I had kind of had a funny situation happen yesterday. Our show recommends a book called One Up on Wall Street by Peter Lynch, or Beating the Street. It's kind of same book. I think it's an update. And if you read that book, it gives you the fundamentals of good investing, and from one of the best managers in the history of time, perhaps the best ever. And as you go through it, there are all these investment fundamentals that he teaches, and typically they roll over time in terms of how they might impact your investing or trading activity. So what's fascinating to me is how, yes, you need a book like that to sort of globally understand good investing process. And then there's the next step that we suggest with Taleb's book, The Black Swan, where it turns out that 1 out of every 100,000 swans is black. And there's a concept called a black swan event. And so there'll be things that occur on a once every 100,000 time circumstance that are unique, tradable, profitable situations, and understanding those can be very helpful, hence our recommendation of that book. So the issue that sort of bounces off of that, in this case, is what one might call black swan trading events associated with where are we with Tesla right now, heading into, we're on a countdown for the entry into the S&P. And so I had one of the sort of dumbest, funniest conversations yesterday with one of the members of our trading group. And what happened was I kind of did a three-way between myself, a former Wall Street analyst, and one of our trading buddies, and we were talking about kind of generally where are we right now with Tesla and what's happening with the stock price, et cetera. And it was a chuckle because there's sort of rule-based processes for how you do trades, how you do investing. The challenge is that there'll be short windows, or maybe not so short windows in Tesla's case, where there's a whole raft of good fundamental investing process. And there'll be certain entities that violate all these rules of good investment process, and they still do really well. So it creates this interesting conundrum where you have people that have been grounded carefully in how things should work, how you invest, et cetera. And then something comes up, violates all those rules. And those very violations should be reasons why the company goes out of business or other bad things might happen to that entity because of the rule violations. And in Tesla's case, they're doing all these rule violations and they're getting away with them successfully. And everybody that's joining Tesla in the rule violations is making a ton of money. So an example of a rule violation that kind of pops up for me is we have something that we developed called the 3-day rule. And what that 3-day rule is, you can skip 3 minutes if you'd like to not hear it because you already know it. But our 3-day rule concept is that something major happens for our company. they issue shares, earnings come out, there's a whole list of what that could be. So what then happens is there are these people called large investment managers. So there's certain people who make $5 to $20 million, maybe even $30 million a year, and their job is to sit back on top of very large piles of cash that you've put in your pension fund and manage that. And they need to be very careful in everything they do because it's a documented moves that are made that determine if something doesn't go well. They need to go back and look at the documentation. If they were well documented in their moves, they don't lose their jobs, nothing happens, because it happened to everybody. Enron, for example. The problem, though, is what if you become a rogue and you do something way different than what the market told you to do, and now, or the analyst told you to do, and now not only do you get fired by the company you're with, but the other entities all watch each other. And if you got fired by one, it's a high likelihood you won't get hired by the second. So there's a very hidebound tradition process for how investments are done at the very big scale. So in our 3-day rule circumstance, what we're kind of looking at is the fact that once a company event occurs, there's about a day, day and a half for those analysts to digest the new information, plug that into their spreadsheets, write a new report, possibly with little wrinkles that they've determined from the new information, send that to the large funds, and the funds will pay for reports from numerous entities. And then what'll happen is that the analysts at the fund will read that, they'll do a committee meeting, and then that whole activity is about 3 days. After it's done in 2 days, 2.5 days, you start seeing movement of the stock on day 3, where the stock will actually move up or down based on what those managers have gleaned from the reports they've received. And then they have their trading that goes with it. So I bring up this circumstance in this case of a rule violation for the 3-day rule because think about what just happened. Tesla issued $5 billion in shares. Now, if you go back 3 months to the last time Tesla issued $5 billion in shares as part of their, around when they did their split, the stock price actually kind of tanked, and then it did a recovery after about 3 days because people are like, oh, they've got cash to work with. They can do things like get the company better organized, have the money to build the plants, et cetera. So it was just very interesting to me that we're kind of in the zone where 3 months ago, it took 3 days for the market to recover from that new piece of news. And part of the recovery was giving the analyst an opportunity to digest that data and then put it out. So in this case, Tesla's stock price went from about $669 all the way down to like $615 as soon as it was announced the $5 billion issue of shares by Tesla. Now, that was an interesting circumstance because, again, it took 3 days, 3 months ago for the market to digest that information. This time, it took 6 hours for the same activity. And now, what is this all about? Well, you could argue that, hey, the one major argument you would make is that the whole 3-day rule is screwed because you now have everything accelerated in this zone as we enter the S&P. The answer, I think, to this is that the 3-day rule is still in effect, and I still expect the large managers to rely on good analytical work to determine what they're doing. But the problem right now is that there's a large group of managers of large amounts of money that have to be in Tesla by the time that earnings are announced or the entry into the S&P is announced. So what this creates is this fascinating circumstance where you have the regular process of a company that I just described with the 3-day rule, but now we're in the accelerated process of what happens relative to the S&P. So what should have happened is Tesla stock price stays down at 620 all the way until, let's say, Thursday or Friday of this week. What actually happened, as you saw, was a quick recovery of the stock. And what it really illustrates is that there's a large group of people that are required to buy the stock. And any dip for any good reason, bad reason, whatever, these folks are still mandated to purchase that stock. And so therefore, a bunch of rules that were in place prior are really not applicable right now. And they're kind of suspended because we're in a very heated zone that is extremely profitable for those who can figure it out. And it's kind of nutso. So I would say that there's a concept called buying the dip. And I think that's what we're seeing here, where if there is a dip in shares or share prices, we're seeing a buy of that dip by institutions and individuals that recognize this is an opportunity, rather than, hey, is the company going out of business? There's a whole list of what could be happening when that stock price falls. It could, the range is the CEO is crazy, somebody got killed. There are all these lists of items, but once we go to, oh, they raised $5 billion, what does that really mean? And a bunch of people threw some stuff in my comment section and argued, 1% of shares issued, not a big deal. Company has more money to operate more efficiently. It makes a whole bunch of sense, but the initial move is to run for the hills and then come back after everything's been declared okay. And usually the analysts are the ones that declare the okay, and then big institutions can start buying again. And this kind of is not happening this time. So there's an empirical process, meaning you're sort of riding the data wave to figure out what's going on, what to do. And it's fascinating right now to watch all these in-hand old-time rules getting violated. And then as the rule is violated, you end up with a lot of people making money when they violated the rule because they were buying in while everybody was running for the hills. So this, as a sidebar note, this is one of the problems with Tesla right now, is that the stock price is very high and rising. And there are a lot of hidebound rules on fundamentals that Tesla has violated. And there's a large number of hedge funds that tried to ride those violations as a way to make a lot of money, shorting the stock. The problem is the stock didn't go down. It kept going up. So all of a sudden, there are all these pros that have a handbook that's been handed out on good fundamental investing process that Tesla kind of doesn't fit. And they tried to figure out how to both tell the story and put their money where their mouth was, and got wiped out trying to, if you will, bet against Tesla and the success that they're enjoying. So it's an interesting zone that we're in right now, because I really feel like the 3-day rule I just described to you is a fairly common thing that I kind of developed over the last 20, 25 years of investing. And it was kind of fun to see it violated by the fact that the amount of money rolling towards the S&P is so large that some of these really good rules that everybody has, they're just not working like they usually do. And people are profitably violating those rules. So kind of where does that put us now? Well, it's fascinating because there's a wall of money that's moving towards Tesla right now. And I think this is going to be interesting because if you look at volumes and stock prices today, the stock price is actually rising pre-market. Now, what I think is amazing is that we have a kind of an interesting circumstance going on, which is that, yes, we have the regular investors, and I expect their 3-day process to still play, and they have a lot of money to invest, so I expect them to have analyst reaction positively, and then the stock price will move further. But there's a whole new crowd of buyers, investors that have come in, and they really don't care about waiting for those 3 days. They're waiting for 6 hours to do their own analysis and then make their move on the stock. So I just had, I wanted to note to you, we do block people and delete you from our channel if you send dumb comments that are mean in our comment section. And I mention this to you because I just saw 2 shows ago an incredible analysis by one of our viewers. What he did was he went back and on like 6 stocks like Amazon, Yahoo, etc., he looked at the trends on those stock prices 3 days prior to S&P entry and 3 days after. And he kind of did a report that he put as a message. I think it warrants me doing an interview with him to talk with him about what his views were, because it's such good analysis. But that's what's beautiful about sort of having a clean comment space where people can share really good ideas that we can all benefit from as investors. And I thought this was a really cool piece that he did. And I want to encourage more folks to sort of do your research and put it in there, because we can all use more data points that make sense to make decisions as we head into what's going to happen with Tesla during this period heading into the S&P. The one fly I saw in the ointment of what he was describing is that most of the companies like Google, Yahoo, et cetera, they tend to don't have physical products, and they were profitable because of the margins for the industry they're in being so large. And so I'm kind of fascinated by the fact that Tesla has a habit of creating its own rules. So a lot of good investment managers, and even Peter Lynch, et cetera, have a whole raft of these really good rules that are hidebound, tradition-bound, demonstrate over time to work, and therefore they should be applying to Tesla, and they really don't for a whole bunch of reasons. And so in essence, what we're saying here is that, yeah, Tesla violated the 3-day rule. Yeah, the 3-day rule turned into the 6-hour rule. But what if you have a group of investors who want in, and they're trying to get in at a better price than was available a day or two ago? So they don't care, they're just gonna buy, and they have large enough amounts of dollars to move the stock price significantly. So I listed the show as Tesla 1000, and I just think that we're getting into a chaos zone right now where you could see dramatic rises in prices without having a whole bunch more information. Let me give you one scenario of how and why that is. The answer is what we've been seeing thus far for the last 3 months is that S&P kind of said, nah, we want you in, Elon, but the problem is that you don't have enough shares out there for our investors to be able to get the allocations they need to maintain the integrity of the agreement they have relative to the S&P's weightings. Elon's response was, oh, okay, we'll split the stock. We'll also start issuing blocks of shares as a way to increase the float so that we can accommodate you guys. And so that's what we saw yesterday in terms of an increase in the number of shares out there. Feels to me like they needed to issue, and I agree with a number of my commenters, that they needed to issue $50 billion, maybe $80 billion worth of shares, and that would have made the whole thing kind of work comfortably, because they didn't issue that much, and there's such demand for those shares that do exist. I really think that we're starting to see a push up in the price. So there was a lot of ways in which we could get to the date, which would have been a very gradual rise in the stock price, and then we're there. But it just feels like the way things are going to go is 50, 100-point moves up as we push into the execution of the S&P. And the other problem that's happening right now is kind of nobody knows what's going to happen on the 21st / the 3 days afterwards. Because in theory, what should happen is that the hedge fund managers accumulate huge numbers of shares. The price of Tesla stock spikes up, and then all the buyers that had to buy are buying along the way, possibly at the highest number. And then as soon as the S&P entry is complete, stock price falls because the number that it was pushed up to was sort of artificially created by a large number of very successful hedge funds and others, forcing big managers into that circumstance. So we're going to find out what the answer is to how this is all going to work. But there's a question that's counter to that, which is, well, wait a second, what if all the managers who are forced to buy even at high prices decide we ain't selling our shares because we have to stay in S&P compliance weighting-wise? And so it's kind of like, oh, now that's a reason why the stock may not fall, because you need the other side of the cliff, which is a whole bunch of people selling, which tends to drop the stock price versus them buying more. And what's the scenario of them buying more? Well, if you're a market-weighted index, and Tesla's not just talking about S&P, there are other indices or allocation structures that Tesla is a part of. And so all of them are influencing. So one of the things you can see is stock prices start rising, and they start rising because they're rising. So in this case, one could argue, wait a second, Tesla stock price is up, that's cool. Wait a second, could it keep going up? Yeah, because if your market cap is rising and the indice that you're a part of is based on your market cap, your increasing market cap causes them to buy, which increases your market cap further. So this is why sort of investing, trading Tesla right now is challenging to get all the analytical points, because there can be very obvious things like this manager needs to buy X amount. Yeah, but when you buy X amount, you're raising the market cap of the company as the stock price rises, which means you have to buy more. So this sort of gets you into the mode of saying, we're in a very interesting zone, very profitable for those that are shareholders, and that it could continue. And don't be surprised by sudden spikes that might take the stock to $1,000 a share in a week and a half. And if you're a regular investor, it can't be ignored, because a nice 20%, 25% return in a week is actually a great number that you'd love to have for an entire year for the average stock. So it is worth paying attention, even though it's sort of outside the boundaries of what's considered good core investment process. So we'll keep you posted on this as we go through the preparation. We now switch to our health tips. Don't forget, 25 leg lifts per leg per day strengthens the quad muscles, reduces chance of knee issues. I also want to encourage you to consider a 5-2 or other diet. Number 3, wanted to encourage you to consider, don't go to bed within 4 hours, best minimum 2 hours to avoid acid reflux, recommended by one of our docs from the University of Louisville who does upper respiratory cancer, which you can get from this. He did also say that good idea to try to use antacids and other things to reduce the initial pain, but it actually masks the damage that's being done, is what he shared with us. Also wanted to encourage you to consider, 30 SPF or better, reducing skin cancer possibilities. And then finally, for those of you who enjoy lovemaking, might be a good idea to consider a small salad or something of that ilk prior to lovemaking, because it turns out that blood flow determines how that food is digested, but it also affects other things in the body as well. And if you have blood flow devoted to digesting a meal, will not be available for enjoyment. At any rate, this is Greg for Teslafaninsight. Wanted to thank you for joining us. Tschüss, German, au revoir, French, Leithroad, Hebrew, Choda Hafez, Farsi. Zdravstvuyte, hello in Russian, Ni hao ma, hello in Chinese. Ohio gozaimasu, Japanese, heido, Swedish, Zdravstvuyte, Russian again, namaste, Hindi. And in Jamaica, we say, enough respect, walk good. Thanks for joining us. Mahalo. Have a great day.